The Russell 2000 continues to outperform today. This is the highest you have seen the small cap Russell 2000 index since January of 2022. And Mark Newton with fundstrat is out with a new word on why stocks should outperform well into 2025. And Tom Lee also reshared this. Mark Newton shared this post from Gilhern Tavares on X that says this is getting absolutely insane. A reversion is inevitable and compares 2008 and the bearish divergence in the RSI to what we are seeing today, suggesting there can be large downside from here. Mark Newton says the widespread consensus is that mean reversion out of large cap tech should happen soon. But why? My indicators say SPX, which is the S&P 500, outperforms into 2025, and technically breakouts of 15-year cup and handles shouldn't be faded as soon as possible. The real test will be earnings. As earnings expectations just continue to go higher, fueling the markets higher, it's time companies need to deliver on these high expectations. And we did get a little bit of bad news today on that front. Core PPI month over month came in at 0.4%. We were expecting a number of 0.2%. So this was actually twice as worse as we thought it was going to be. And why is this potentially a bad sign for corporate earnings? Not guaranteed, but it could be a bad sign because if producer costs are going higher, but consumer costs are going lower, what does that mean? Well, that means companies could be stretched on margin. Companies' costs are still going up, but they're unable to pass those costs on to consumers. That could actually mean some profit erosion in the coming quarters. Headline PPI came in at 0.2%. We were expecting 0.1%, and you did get a upwards revision from last month. We were at negative 0.2% and revised up to 0%. The core PPI had a huge revision from 0% last month to positive 0.3%. So I guess when you look at month over month numbers, it could have been worse because now we're comparing 0.3%. You're only at 0.4%. So that's a slight jump compared to, 0% going to 0.2%. That, I guess, statistically could have been a larger jump, but the revisions kind of helped the markets there. But still, these are pretty bad numbers compared to CPI that we just had yesterday that came in well below everyone's expectations. We also got Michigan consumer sentiment that came in at 66.0. We were expecting 68.5, so this came in worse than expected. Consumer expectations came in at 67.2. We were expecting 69.8, and Michigan current conditions came in at 64.1. We were expecting 66.3. Some of the optimism probably comes from your one-year inflation expectations that came in at 2.9% today. Last month we were at 3%, and we were expecting another 3% rating. So lower one-year inflation expectations and lower five-year inflation expectations down to 2.9% from last month's number of 3%, which was also the consensus again for this month's report. So that is helping markets go higher today. I'm actually kind of surprised that PPI coming in hotter than expected, had basically no reaction to markets. As Gunjan Benjiri says, she runs the Wall Street Journal and covers money over there, a contributor to CNBC as well. She says the Russell 2000 outperformed the NASDAQ by 5.5%. That's the largest spread on record. And the last big spread here we had was at the end of 2008, and that was actually a period in time where the markets did fall a little bit more, but then you ended up rallying back. And I have to say, markets look a lot better today than they did just 2 or 3 days ago. That is because you are starting to see broader participation, the rest of the markets that are actually going higher as well. And you can see the equal weight S&P 500 is almost breaking a new all-time high. You're just like 50 cents off of that right now. And the equal weighted S&P is up about 1% today. Yesterday, the equal weight was up 1.2%, and the day before the equal weight was up 1%. So you're definitely starting to see more stocks participate in this market. Here today, it's kind of a mixed bag with big tech. You have Apple that's up 1.5% on a new upgrade and price target raise today. Nvidia that's up 2.3%. You have Google down 0.1%, Meta down almost 2%, Amazon down 0.2%, and Microsoft down about 0.25%. So this broader rotation out of big tech still continues today, but to a lesser extent. I do think throughout this earnings season, you're probably going to get more of that rotation because those big tech earnings estimates are just far too high, and it's going to be hard to impress investors at this point. And as we've seen from last earnings season and so far this earnings season, if there's one thing that's wrong or not great, companies are getting wrecked from that. And here you can see this chart from Bloomberg that does yet again confirm this rotation is back, and it's the largest rotation that you have seen since 2020. Seth Golden writes on X, if the current bull market were to end soon, it would be only the second shortest confirmed bull market in history. Likely much more time on the clock, bear markets are far quicker, and why you should take advantage, not fear them. As Bespoke shares in this chart, the median return of a bull market is about 76.7%. If you consider this bull market started on the lows back in 2022, then this bull market has effectively rallied about 66%. If you consider this bull market started during the 2020 lows, then you're up 175%. And Gilherme Tavares on X says history doesn't repeat itself, but it often rhymes, again citing this relative strength divergence, markets hitting new all-time highs, the RSI still not even close to hitting new all-time highs, and he's looking at this on a monthly candlestick chart. Charlie over on X says small caps outperformed large caps by 4.5%, a 6 standard deviation event, and the second biggest outperformance on record, trailing only the 10 sigma differential on October 10th, 2008. Not to get too complicated, but 6 sigma events should happen every 506 million days. So needless to say, yesterday was a true anomaly. What's truly impressive about this recent multi-day rally that we have now seen is the percent of stocks that are trading above their 50-day moving average, currently at 63.71%. Just a couple of days ago, maybe a week or two ago, you were at about 35% of stocks trading above their 50-day moving average. So you went from 35% of stocks to almost 64% of stocks trading above their 50-day moving average in a very short amount of time. And if we take a look at the SPY, the ETF that tracks the S&P 500 over on StockTwits to get a sense of how retail is feeling about our markets, well, they're still bearish. The score today is 25. I would expect it to get a little bit better, albeit you're seeing the average stock that's starting to go higher, but retail's still not convinced this rally is the real deal. They're still bearish. Message volume today is high at 62. But if we take a look at the triple Qs, people feel a lot more optimistic there with a score of 60 today, which is bullish, yesterday being bearish at 33. A lot of this recent optimism is, yes, fueled by the CPI report that came out yesterday, but this has basically confirmed you're going to get that first rate cut from the Fed September 18th. Currently, the odds are at 90.3%. There is a 6% chance of 2 rate cuts. That's either a 50 basis point rate cut in September or a rate cut at the end of this month, July 31st, and September. So 2 cuts by September. There is only a 3.8% chance of no cut at all between now and September. So you're telling me there's a greater chance or greater likelihood of 2 cuts by September rather than no cuts by September. Yeah, that's going to get people optimistic. Of course, earnings need to come through. The economy needs to hold up. As long as those 2 things happen, this is a raging bull market. And yes, personally, I'm still concerned that Apple trading at $231, Nvidia at $130, or Google, Microsoft, Amazon, Meta near all-time highs is still very overextended. And truly, if we do get a soft landing and a Fed that starts cutting rates and this Fed put comes back, I don't think these stocks deserve the kind of multiples that they have, and I think expectations are too high. I'm still a little nervous heading into earnings season, but it could be a stock picker's market even for this earnings season. For an example, Apple disappointing may not necessarily mean the markets need to sell off completely. I do think there are other risks as well, including the election and what can even happen from now until the election. If young Biden were to step down, for an example, that's a potential risk, but that's not an investment theory. So anyone telling you that you should sell stocks or be fearful because of politics or anything else doesn't understand the markets anyways, and you probably should just in one ear out the other with anything they say. Now, I do want to share this clip with you from Kilberg that says if markets keep reshuffling, volatility will see a comeback. Because it has been a long time since we have had any kind of volatility at all. And I think the longer we go, this stretch of really no volatility, it raises the odds that we could start to see more volatility again. After all, it's been like 400 days since we have seen a 2% down day for the S&P 500.
Here, Denny saying he wouldn't mind if the Mag 7 did nothing and the money all went to those quote-unquote left for dead sectors. If that happens, let's just pull on that thread again, how do you see that impact in the market?
Well, I think we all want to have our cake and eat it too, Frank. But when you see that stark contrast like we saw yesterday, where the S&P 500 was down 1%, and you saw the Russell 2000, which, by the way, has been dragging about 12% year-to-date to the S&P 500. If you look on a 3-year perspective, Frank, you have seen dramatic underperformance by the Russell 2000. But yesterday was really a highlight on significant volume. You saw the S&P 500 down 1%, led by the Magnificent Seven. On average, the Magnificent Seven was down about 4%. But the other 400 names in the S&P 500 were actually up over 1%. So I think if we see follow through on this theme, this reshuffling of the deck with this repositioning by investors, I think volatility is actually going to come back, and you'll see the VIX pop above 18 or 20, and that could really be an opportunity as people reposition.
Yeah, a lot of people think volatility is better for single stock investors as opposed to people who are index investors or passive investors. So Edgar Denny says we might have an inflection point. I want to get a sense of how you see today. What's your WEX word of the day?
My WEX word of the day is recalibrate. I think yesterday really was like a large rock or even a boulder being thrown into the middle of a pond. There are reverberations, there are ripple effects from that. So if you see follow through, look already at the S&P 500. Yes, it's trying to bounce back a little bit, but the Russell 2000 in the pre-market up over another 1%. So I think you're going to continue to see profit taking from the Mag 7. But if that profit taking turns into repositioning, reshuffling, NVIDIA itself is owned in over 500 ETFs. So if you see some trimming, some profit taking, those reverberations, that recalibration will continue, Frank.
That was very interesting. He suggested the VIX could make its way to 18 or 19 or so. Why that's interesting is because the VIX is down 5.5% today. There's nobody buying puts out there on the S&P 500. Obviously there are, but not as much as calls. It is a call-dominated day today, and people are not fearful at all. And the VIX today is at $12.22. And the last time we had a VIX between 18 and 20 was back here in April of 2024. And that was when the S&P sold off about 6% following last quarter's earnings. Carl from CNBC is reporting from Bloomberg that bond traders are ramping up bets that the Federal Reserve will cut interest rates by 0.5 percentage point in September instead of the standard quarter point increase. It's important to remember that next week we have retail sales. We're expecting a pretty bad number there. Could be in contraction for the month of June. We have basically 2 of all data coming out between now and September. If we get 2 more really good inflation reports, if the economy continues to weaken from now until September 18th, it could be probable to expect a 50 basis point cut. Now, let me tell you right now, if we get a 50 basis point cut, if that starts to become priced into the markets, I doubt stocks are going to be doing well. That's because anytime the Fed cuts into weakness, no matter what inflation is doing, that's seen as negative for markets, and the average drawdown is about 23% upon the first Fed cut. because again, typically the Fed is cutting into weakness. Now, there's obviously some time between then and now, but it's worth considering. It matters why the Fed is cutting rates and what's going on with the economy. We also do have a speech from Fed Jerome Powell next Monday on July 15th, and that will also be another big event, because if the Fed, for whatever reason, wants to potentially cut rates in July, then this would be Powell's time to really open that opportunity up. Which at this point, if there's people considering the Fed may cut rates 50 basis points in September, why not cut once in July anyways? Peter Burson on X says NVIDIA EPS estimates have fallen over the past 30 days. The EPS estimates have actually went from 63 cents down to 59 cents, which is something we normally never see for NVIDIA. And here you can see consumer loans, the component of PPI, plunged by 8.9% month over month in June, by far the biggest plunge we have seen since at least 2010. Is another sign of a weakening economy, and I guess that's what happens when the Fed jacks up rates this high and people are stretched. The last thing people can afford is to go out and get a new loan payment. And a fun fact, it's being reported that retail traders make up 18.8% of total option activity, approaching a record. Liz Ann Saunders on X says the rule of 20, which suggests markets are fairly valued when CPI year over year and S&P 500's PE add to 20, is one metric that shows the market is getting increasingly expensive. I actually think the markets are not that expensive, just the concentration levels continue to be problematic. And the markets are not too expensive if earnings actually come in at 15% growth for 2025. I just think the risks are higher than what the markets think of a recession, of a deeper slowdown in the consumer, and overall earnings not coming in as good as expected. The markets right now are not even pricing in any risk, and I think there should be some risk priced into markets. And I know that sounds crazy for anyone that is super bullish, but yes, it's normal for risk to be priced into markets. Fundstrat writes on X, CPI miss leads to big drawdowns in yields in US dollar. Some minor mean reversion happened on Thursday as equal-weighted S&P 500 turned higher to multi-day highs, while SPX and QQQ both fell to multi-day lows. And Fundstrat provides this chart suggesting that if you do see a break of this trend line in the equal weight ETF, then you could see markets go even higher. And just to get up to this trend line, you would see another 2 to 3% advance. David Rosenberg says the market bulls are feeling good, but when they come on Bubble Vision to say this is an earnings-driven rally, they are completely out to lunch. If this was all about earnings growth, the S&P 500 would be sitting at 4,800, not 5,600. It's mostly about FOMO, sentiment, momentum, extraordinarily popular delusions, and the madness of crowds, which David Rosenberg is getting a lot of hate on X. If you look at the comments of those tweets, he's getting a lot of hate. But I mean, one thing is true. Expectations are very high, and the risk to reward isn't favorable heading into an election. Among the other obvious risks, oil is declining by 0.5% today. The dollar is down by 1/3%, continuing to support this outperformance of your small caps and your equal weight S&P. And TLT is up 0.14% today. We did have big bank earnings from JP Morgan, Wells Fargo, Citi, and others, which really across the board, it was a bit of a mixed bag, with most bank stocks declining by about 2% today. So let me know what you think about this information down below in the comments section. Hit the like button as well as subscribe to the channel. You guys have a fantastic weekend, and I will see you in the next one.